If you need to borrow money, then what are your options? One option would be an overdraft. An overdraft is a type of borrowing that allows customers to spend more than they have in their bank account. It means that the customer can continue to withdraw money and spend money even if their balance is zero or a minus figure. Basically, if you've used your overdraft, you have a negative bank balance. For example, minus £200. To use an overdraft, account holders must first arrange that with their bank and agree to the terms and conditions of that overdraft. Overdrafts often come with fees and interest charges, and they should be used carefully and aren't really suitable for larger purchases such as a house or a car. Personal loans is another form of borrowing and is when a customer acquires a loan to make a purchase such as a car or home improvements. Because personal loans are used for larger purchases, they're not suitable for short-term financial needs. To apply for a personal loan, an individual will typically have to give the bank or financial institution information about their expenses and income. The bank will then take a look at their credit history and assess whether they can afford this personal loan. If the lender approves the loan, then the individual will receive these funds into their account and agree to repay the loan and any interest over a specified period of time until the loan is fully paid off. Personal loans can be a useful form of borrowing as the repayments are set out clearly and often interest rates on personal loans are quite competitive. However, you need to make sure that you can afford to pay them back, or you could end up in financial difficulty. Hire purchase is a financing arrangement where a customer agrees to pay for an item, such as a car, in regular instalments over a set period of time. Hire purchase agreements often involve a customer making a down payment along with monthly payments until the item is fully paid off. While payments are being made, the customer uses that item, such as the car. However, they don't own that item until they make their final payment. Up until then, the seller still owns the car, even though the customer is using it. Once they make that final payment that's in the hire purchase agreement, then ownership of that item will go to the customer. One problem with hire purchase arrangements is that they're often manipulated to seem like really good deals. In reality, they're not as competitive with personal loans and other forms of borrowing, where interest rates are often much lower. You may have heard of this next form of borrowing, a mortgage. Mortgages are loans from a bank used to purchase a property. Usually, these loans last from 15 to 30 years. To take out a mortgage, the lender will review the customer's financial background, including their income, expenses, and credit history. This will determine whether they're eligible for a mortgage, but also what interest rate they'll pay on the mortgage. If you're in a better financial situation, this often leads to getting better rates on a mortgage. If you get approved for a mortgage, then you'll make monthly payments plus interest until the mortgage is paid off. Once your mortgage is paid off, you then own the property that you live in. However, up until this point, if you fail to make payments consistently, then the bank will have the right to repossess your home, effectively making you homeless. Next up is credit cards. A credit card is a type of payment card that allows you to borrow money to make purchases and withdraw cash. It's similar to a debit card, but a credit card uses borrowed money from a financial institution, such as a bank. And because it's borrowed money, you'll have to pay this money back along with any interest and fees that are outlined in the credit card agreement. When you're issued with a credit card, you'll be given a credit limit. This is usually determined by how much you earn and your credit history. If there's two people with a good credit history, someone earning 100k will have a higher credit limit than someone earning 20k. This is because the higher earner will be able to pay back more money that is borrowed. After they hit that credit limit, they won't be able to make any further purchases. Because credit cards can be used to withdraw cash, pay for things at restaurants, buy clothes, an iPhone, then it can easily encourage people to overspend on things that they don't particularly need. This is a danger of having a credit card. However, many credit cards have an interest-free period where if you pay that full amount off every month spent on that credit card, then you'll pay no interest. The danger is, if you don't pay it back in full within this interest-free period, then interest rates are typically quite high on credit cards, meaning that the balance on your credit card can quickly build up and put you into unmanageable debt. Finally, we come to payday loans, which in my opinion is one of the worst ways to borrow money. Payday loans are often short-term, high-interest loans that typically need to be repaid by the borrower's next payday, hence the term payday loan. Payday loans are designed to give people quick access to cash who need it for emergencies or unexpected bills. And because of this, the loans are often small amounts between £50 and £1,000. Payday loans are known for their high interest rates that are often several times higher than interest rates on other types of loans. Because of these massive interest rates and the fact that the loan needs to be repaid by the next payday can mean that if you miss payments, you soon spiral into uncontrollable debt, where people are often forced to take out other payday loans to pay off the previous payday loan. Because of these reasons, payday loans have a terrible reputation, and everyone should consider other alternatives before turning to a payday loan.